welcome to BQ Pram. I'm Hiral Dadia. A very good morning to all the viewers. Joining us on the show today to discuss the movers and shakers, we have Mr. G Chokkalingam, founder and head of research. Welcome to of Equinomics. Welcome to the show, Mr. Chokkalingam. Mr. Chokkalingam, my first question coming to you is overall, after the Fed announced a 25 basis point hike last evening, clearly it seems that our markets are pretty much resilient and it seems priced in because we've not seen a major reaction to the way US markets ended. And you have a comeback that's seen from the day's lowest levels, 100 points recovery in terms of Nifty already in the first hour of trade. Firstly, if you have to talk about the banking names overall from this perspective, what's the sense that you pick up?
Yeah. Good morning. To answer your specific question, I must tell you two things. One, our markets are resilient because it's always proven in the history also that global pain is India's gain. Global pain translate in terms of oil price crash. That's what happened now also. Oil price is down almost 44% from 52-week high. That's what helping the market to remain resilient. So therefore, I remain quite optimistic. Second, coming to the banking sector, very interestingly, our banking sector this time is posting a record level of credit growth, which is around 15%, which is a nearly decade high. And secondly, the NPAs have come down to decade low, whether you take a gross NPA or net NPA. And most importantly, the dependence of Indian banking system on the external economy or external banks, financial sector, is the least. If you look at the balance sheet of Indian banks, the external borrowing is hardly 4 to 5% of the total balance sheet size. And lending also, 99% of the lending happens within India. So therefore, one need not worry at all about the banking stocks here, and it will be an opportunity. And two specific names I would suggest. One is HDFC Bank and second is Maharashtra Bank, Bank of Maharashtra. So these are the two stocks one can use this opportunity to accumulate.
Right. So that's a good suggestion coming in from the banking names. Moving on, the contagion in terms of the banking collapse that we've seen in terms of US as well as Europe, that's having an impact on the IT counters as well. And we've seen constant downward pressure, not only on the mid caps, but also on the large caps as well. A lot of clarity emerging that, yes, there could be exposure, which could be highest in terms of a TCS or an Infosys. These are the names that they're appearing. But again, the mid-cap IT counters are also seeing or glaring at an exposure to, any of these banks in the US and Europe. What would you recommend an investor to do with IT counters at current levels? Because again, we are very close to Q4 earnings. The commentary is also going to be crucial from here on.
Yeah. Yes, IT stocks had a problem even before the bank fall. Last few years, the IT exports is growing in a poor single digit in dollar term. And then they had a problem of employee attrition and a spike in the employee cost. On top of this, now the banking turmoil has come in Western world. Yes, it would be wrong to say that the IT sector would remain robust despite the failure of some banks there, because almost 1/3 of revenue or profits of large IT companies come from banking sector, BFSI sector. So there will be little more pain. However, one has to keep in mind the fact that the IT stocks have already corrected. Even the large cap stocks have corrected anywhere from 20 to 30%. Some of the small and mid cap names have corrected even 30, 40, 50%. So therefore, what I would suggest that hold on to large IT stocks, don't do any distressed loss booking, and look at the quality names in the small and mid cap, because if you see last 10 years before COVID, we have seen a lot of consolidation, a lot of small IT companies being taken over. So I believe in the new environment where the single digit growth is happening, the banking sector is going through difficult time, the merger and acquisition would, once again take a shape in the IT domain. So therefore, buy quality IT stocks in the small and mid cap space. One such idea I would suggest is Gensa Technology. The stock has corrected a lot. It's extremely attractive in terms of valuation. And also the attrition has come down for the whole sector. Even year-on-year employee cost has come down in this December quarter as compared to September quarter. So therefore, my suggestion is hold on to large IT names, and in the small cap, mid cap space, buy stock like Gensa. Just I want to disclose that we have personally invested in Gensa Technology.
Right. So that's with regards to IT majors. Moving on, Hindustan Aeronautics, that stock has been in focus as well. In fact, the entire defense pack has been in focus in the last 1.5 month. And now, as we know that the government has launched an OFS to sell around 3.5% stake, and the floor price is at a discount, 2450 is what they're looking at. The stock is trading under pressure in today's session. Firstly, what would you recommend someone who's holding, an investor to do with a HAL? Because overall there is pressure. Would you expect this investor to hold on to the counter?
I would suggest sell for two reasons. If you look at the balance sheet, it is always under some stress. The receivables and inventory account for almost 81% of annualized sales. So normally, in my own way of picking up stock, I do not buy such stocks with a heavy working capital condition. And secondly, I'm little nervous on defense PSUs. After a few years back, what happened to Bharat Electronics? It had to compromise on the operating margin. Now also considering the fiscal deficit and some stress in terms of subsidies for the government, there is a possibility of defense PSUs helping the government by compromising on the margin. It's only a possibility which has already had a precedence. So therefore, I would suggest sell HAL and buy stocks like Coal India or Oil India. Both are single-digit PE and extraordinary balance sheet, and well positioned in terms of demand for coal and the refinery products for Oil India. So one can consider one of these two stocks rather than stock like HAL, which is into defense space.
Right. Moving on, Asian Paints has been an interesting counter, Mr. Chokkalingam, because since the time crude was inching lower, we did see a lot of momentum in terms of Asian Paints. Today, the stock has been trading under pressure, and this is on the back of global brokerages who are highlighting concerns with regards to foray of Grasim, who's coming into the sector, whose first plant will be commissioned actually overall in terms of FY24. I think it's the fourth quarter of FY24. Secondly, if you see in terms of the company has been facing margin pressures as well. However, the anticipation was that there will be a revival in terms of volumes from the fourth quarter onwards. So overall, what would you advise someone to do? I mean, someone who's holding an Asian Paints, should the investor book profits at current levels? That's number one. And two, someone who's looking to hold an Asian Paints, would this be a good time to enter the counter?
Yeah, very interesting question. And in fact, you hit the major structural change happening in the paint industry. Ultimately in the equity market, a major structural change in the sector or economy, that's what creates a wealth or destroys a wealth. Now, as you also mentioned, both JSW Steel and Grasim entering the paint industry is a massive structural change in the paint sector. So I have been negative on Asian Paint in almost for last 1 year. Because if you look at the proposed capacity setup by JSW Group and Grasim, I believe it's almost 50% of the existing paint capacity in the country. So, which is going to shaken up the entire industry, and it's going to be a problem for existing player. It is going to be a problem for new player as well, because the supply overnight will shoot up like anything, and I don't think the demand can jump proportionate to the supply. So therefore, one should sell Asian Paints, and within the large cap space, one can consider stock like Reliance Industry. That is where I believe, because it is emerging as an economy, this Reliance Industry, and they have built successfully a size in telecom and retail. Now I am pretty confident that they would repeat such story in FMCG as well as in the green energy. So one should consider, making use of this structural change in both areas and shift from Asian Paints to Reliance Industries.
Right. So that's an interesting switch coming in from the paint industry to a Reliance Industries. Moving on from the auto pack, Mr. Chokkalingam, you have Tata Motors, which has already gone ahead and is looking to hike prices in the CV space. Now you have Hero Moto, which is looking to hike prices of motorcycles and scooters from April 1 as well. Now, my question is, firstly, you have seen key raw material prices which have started to cool off and stabilize. Now, this price hike, do you think this is something which will help these companies to maintain margins, or will this price hike actually be margin accretive for these automakers? And what would you advise an investor to do?
Yeah, definitely the price hike would help them in improving margin, but then again, this sector is also, price elastic. The demand is price elastic. So you can't take it for granted that the demand would remain intact. So marginal increase in the cost would also affect the demand marginally. But however, if going by business segment, I would prefer Maruti to both Motor and Tata Motor, because I believe Maruti would be able to succeed with the launch of new SUVs to get back its market share close to 50%. And also considering the balance sheet and the backing of Japanese player, I would prefer Maruti to these two stocks.
Right. Moving on, GAIL is in focus as well on the back of the PNGRB order with regards to where the tariff hike goes, right? Now, overall, as we know that the new tariff of integrated national gas pipeline of GAIL would be 58.61 MMBTU, which is almost 45% higher than the current tariff. Firstly, what would it mean for a GAIL? And secondly, how do we view a IGL and an MGL as well, basis the entire value chain?
Yeah. Interestingly, all of us know that ever since the Ukraine war took place in February 2022, the oil and gas space is going for a swing. Both upside and downside, and also it is highly regulated within India. We know, the cess on oil, how it is, fluctuating, and also the gas prices are controlled. And gas prices have gone up substantially. The demand is also slowing down. Many sectors cannot afford this kind of gas price. And particularly GAIL, the performance also, if you look at in December, huge volatility. So oil gas prices are volatile. The policies are also not uniform and consistent for long. It gets altered along with the price fluctuation. And GAIL performance also highly volatile. If you look at the December results, year on year substantial degrowth. So I would say that retail investors, even for a person like me, it's very difficult to understand and take a firm or medium to long term view on this kind of oil and gas sector, pure play. So therefore, I would suggest that to look at HDFC Bank, where the visibility is very clear in terms of the industry credit growth and bank credit growth and profit growth. So I would suggest shift away from GAIL and replace it with the HDFC Bank.
Okay, so that's an interesting shift coming in from a sectoral perspective as well. Apart from that, you have a Coromandel International, which is in focus in today's session, and they're looking to invest almost 1,000 odd crores for foray into the CDMO space, specialty as well as industrial chemicals. The board approval is in place to expand operations in the crop chemical protection chemicals. However, Mr. Chokkalingam, if you see in terms of the last 1 year performance of the stock as well, we've seen a high of around 1,094, but since the last 2 to 3 months, it's been in a pretty broad, narrow range of around, say, 800 to from 900 to around 750 on an average. Do you think this is a good investment opportunity at current levels now?
I'm slightly negative on the fertilizer sector because if you look at the subsidy as proposed in letters to budget for FY24, they have proposed a severe cut in the subsidy. But I am not sure whether the government would actually cut the subsidy without punishing the companies involved in fertilizer making. However, I would not rush to say sell on Coromandel International because this company comes from Murugappa Group and which I have been tracking from 92. Very interesting insight about this Murugappa Group is that whichever company they took over and whichever new business they got in, I don't think they ever failed even in one of their attempts. Consistent success. Whenever they went for diversification or acquisition. So, after a long time, I am seeing the Coromandel International talking about significant investment in diversification within allied business. So, and also the stock has corrected, as we mentioned, by 20% from the 52-week high. So, therefore, one can hold on Coromandel International. And if you get anywhere from 10-15% return, then one can exit the stock.
Right, so that's an interesting one. In fact, Mr. Chokkalingam, this conversation has been absolutely interesting with the kind of shifts that we have recommended, not only a churn within the sector, but a churn from one sector to the other as well, basis the stocks we've discussed. So that's been an interesting one. Thank you so much for speaking to us at BQ Prime. Stay safe and speak to you soon again.
Thank you very much.